Hey everyone, it's Imran back again. All right, what's been going on in these crazy markets? Global stocks under pressure yesterday. You see quite a sea of red there across equities. Had some 2 sigma down moves in Europe. So Europe's really struggling at the moment. As a result, we did see implied vol pop, see about 3 vol move in European short end implied vol. US markets are also softer, but not quite as dramatically. We had some debt ceiling concerns, obviously still. FOMC minutes led to a bit of a hawkish reaction in rates. Stocks not liking that. Cyclicals getting hit. But then obviously after the close, we had Nvidia earnings, which were knockout earnings, up 25%. That's got the NASDAQ futures up 2% pre-open. And that stock just continues to go parabolic, right? And then looking at commodities, we saw metals down. Copper getting whacked 2.5%. GDX, silver, all pretty weak. Gold actually faring a bit better than the rest of the metals. And then energy was actually in the green with oil and nat gas small higher. Looking at skew, we saw a decent spike in skew again, looking at another vol point or so. That takes S&P into the 80th percentile, looking pretty rich there. Asian skew obviously still pretty flat at around 2 vols. They've got a different dynamic going on, especially in the Nikkei, for example. And then looking at commodities, we did see a bit of a put skew bid coming back across the complex with the metals trading badly. And then bonds also seeing some put skew, taking those things back above median levels. HYG actually looking quite high again on a 4 handle. Implied vols in general, like we said, caught a bid. Also commodities seeing a decent bid across the metals there. Gold actually saw vol slightly softer because it's not collapsing quite as fast. And obviously, in general, gold seems to be better supported. People like the structural story in that thing. Bond vols actually are popping. We said bond vols weren't really reacting to the weakness in spot. They did have a little bit of a catch-up bid yesterday, but still nothing too scary, I would say. Still think we're kind of consolidating near the low end of the range. So for now, I'd probably favor we are going to bounce in the long bond at some point fairly soon. That would be my base case. And then looking at sector vols, they were also higher in line with the broader indices. Carry-wise, we see mainly green across the board. The only pockets of red where things are moving a bit more are the likes of China, Nat Gas, and we're seeing ARC there winging around a bit. So that's where the realized vols are actually higher than the average implied vols for the front of the curve. Okay, that's your summary. Looking on. So FOMC minutes did stress data dependence and the potential for more hikes still this year. Rates markets obviously pushed yields a bit higher. We saw that implied DEC 23 rate push up to 485. Obviously, that got down as low as around 375 on the SVB collapse. So that's been quite a decent bounce in yields. We did see, obviously, with the debt ceiling not getting resolved yet and getting closer to a default, not that anyone really believes it's going to happen, but Fitch placed the US on negative credit watch. And that has certainly got echoes of what the type of stuff we saw in 2011, where they actually downgraded the US debt, and that caused a bit of havoc in the market, right? So the fact that credit agencies are now starting to say things like this is a little bit spooky, which is probably why the market did catch a bit of a downside bid for skew and things like that yesterday. Okay. Then the big divergence, the other story, we said bifurcation continues, right? The other side of this story is AI. Everything AI just keeps going higher. Nvidia, absolute knockout numbers. As we said, the stock 25% on huge revenue growth expected in the next quarter. So they had revenues of about 7.2 bill, which was higher than expected. But then for the next quarter, they're estimating something like 11 billion. That's an insane amount of growth. And it seems like based on numbers that these numbers are faster and the growth is quicker than they even anticipated, right? This space is growing so fast, parabolic price action, obviously stupidly high valuations, but once valuations get stupid, there's no limit to how stupid they can go. This is something me and Darius talked about recently. It's dangerous to try and call a top in a bubble, right? The stock looks very bubbly. This looks very overhyped, but, shorting bubbles is hard. You can always buy sort of medium-term puts and put spreads as a way to try and do it safely. So that doesn't look, and there'll be a bit of a vol reset after yesterday's earnings. So maybe you want to kind of let the dust settle and pick up some medium-term puts in Nvidia if you do think this bubble is getting stupid. But the truth is, this innovation with AI is more than a passing fad, right? It's not like the Pelotons or the Beyond Meat type things that were a flash in the pan. Everyone got excited and then it goes away to the next thing. This is a revolutionary technology that will change the way everybody works, and it's being driven and it's being integrated into some of the biggest tech platforms on the planet, like Microsoft. Okay, so because of that, and the fact that, yes, it looks bubbly, it may well have a correction, and a really meaningful correction in the next 6 months because it's got overhyped. But in the next 5 or 10 years, companies like Nvidia are going to be around and they're going to be leaders in the space. And that's why the likes of Stan Druckenmiller, Steve Cohen have been out there recently saying they bought this name, and that's the reason they bought it. They don't give a shit about the drawdowns. They're buying it, and they're buying it for the long term because they think this is a mega trend that isn't going anywhere, basically. So that's what you need to be aware of. Now, you know, if you haven't got any exposure to this stuff, maybe you still buy it today, right? I'm personally not the type of trader who likes buying stock after it's rallied 25%. And let's be clear, it's rallied over 100% so far this year. So I'm not chasing the stock higher, but, you know, like we said, all the arguments are there to want to own this thing longer term. Okay, what else are we looking at? So moderate pop in VIX, obviously on the debt ceiling fears, right? So looking at our VIX dashboard, we've seen a reasonable pop there. Front end there has gone up quite decently. We've got 21 on the front again, about a 3 to 4 volt pop in those front end futures. So we did see VIX spot hit 16 at the end of last week. It's back above 20 again. The roll down is flattened, so the curve is flattened down to only 5.5% from highs at like 11, 12. And so, you know, and we're seeing VVIX and VIX spot both moving up. VVIX was the first one to move. VIX is finally starting to catch up to it. But we do know, you know, often these VIX spikes are pretty short-lived. It might be a little bit early to sell the VIX here, given that the final D-Day that people are calling is like early June, maybe 1 to 2 weeks out still. But, you know, when VIX wants to come back down, it doesn't hang about. It comes down pretty fast, right? So the question is there a smart way to fade this VIX without getting too committed and without paying too much theta and without paying this stupidly high vol where the VVIX is at like a level of 106 now, okay? And that's up 14 vols on the week or something, right? So obviously that's what I look to do, right? I look to find option trades that are efficient, that carry better than your average buying calls and puts blindly, okay? So looking at our vol dashboard on the VIX, it is telling us to go for bearish risk reversals. Now, knowing me, you will know that selling naked calls on the VIX is not something I will ever tell you guys to do because I'm not in the business of blowing up your accounts. So that's a bit of a no-no, I would say, bearish risk reversal on the VIX. At the very, you know, if you have to sell upside, you'll do it via spreads just to cover your back. But even then, you're going to get very little for selling a call spread. So I don't really think it's worth it. So then what do you do? Now, we've got a pretty big inversion in the VIX term structure. So the way we think it makes sense to fade the vol move and get some exposure to a move back down, because we are at the top Bollinger Band on the VIX. So we could easily go back down to the bottom, back down to that 16 area. But we do think it's going to require a few weeks for that to happen because we need to get the debt ceiling stuff resolved. Okay, once it's resolved, it's very likely that vol's going to mean revert back down and normalize, and then you will see VIX trade down. You will see the curve steepen again. So what we like is we like the idea of buying July puts, which are out here, and selling June puts, which are on this expensive pumped up part of the curve. Okay, so we could do that via the 17 strike. It's a fairly low delta stuff. The 17 strike put calendar on the VIX. That's it for today. Thanks for listening as always. Catch you guys tomorrow. Cheers.